Thank you for joining us. As we look ahead to 2016, much like was the case in 2015, we envision a global economic backdrop in which economies are growing, but growing at a modest pace. Also like 2015, we expect central banks of the developed economies to remain very much engaged in aggressive monetary measures to try to drive their growth rates. We also expect commodity prices to remain low, just like 2015. We expect inflationary pressures to be very modest, like 2015, and we expect interest rates on a global basis to remain low, just like 2015. In short, the global backdrop in 2016 should look very much like the one in 2015, and because of that, we're borrowing a theme from the 1993 movie called Groundhog Day as the title for our outlook. Now, for those of you that aren't familiar with the movie, Bill Murray plays a weatherman who relives the same day, Groundhog Day, February 2nd, over and over again. And forgive us because we don't mean to make light of the prospect of reliving 2015 over again. But the important point is that though the macroeconomic backdrop looks very similar, we believe there's a case to be made that the capital market outcomes this year will not be Groundhog Day, that they'll actually be somewhat different than what we just experienced. And to that point, let's take a look first back at what the capital market environment was like in 2015. It was a challenging year. If you look here at the returns of the major asset classes, large cap, small cap, and international equities, as well as bonds, you can see that they ended the year hugging the zero line, if you will. The best performing asset class, large cap stocks, were up 1.4. The worst, international equities, are down 5.3. So there wasn't a big call to be made in terms of asset allocation. The other thing to note is that in August, something changed. All of the risk assets, all the stocks, all of a sudden assumed a correlation of 1 and plummeted altogether. And what that was the outcome from the devaluation of the Chinese yuan by about 5%. And that sent shockwaves around global equity markets as investors took that as a sign that China was panicking about the slowing growth rate that they were experiencing, and investors sold. We're seeing the same thing now as we begin 2016 with growth scare number 2 coming out of China, again devaluing their currency very modestly, this time 0.5%, but the same reaction with global markets selling off about 6% right away in the first week of the year. We think the same thing will happen this year as the latter half of last year. People will get comfortable with the fact that the U.S. isn't heading to recession, that the global profile still calls for about 3.5% to 4% economic growth, and stocks will climb higher out of this. But nonetheless, China is a concern. More on that later. But back to the capital market environment last year, though there wasn't a big allocation call to make for returns, there were some risks out there, and that we by and large avoided those, namely in the smaller asset categories, commodities and emerging markets. They plunged. They were down 17 and almost 25% respectively, and those are very related to what's happening in China and the rebalancing of the Chinese economy. Our international team did a good job of underweighting emerging markets and therefore outperformed the benchmark quite strongly. Commodities, we didn't miss that entirely. We made the wrong call on energy, but save for energy, we were underweight commodities, so we dodged those bullets, if you will, in 2015. Now, getting back to the sell-off here that we saw in global markets, out of that came a change in behavior in investors. When there's a concern about growth, and growth is scarce or dear, oftentimes investors in the short term are very willing to pay almost any price for a company that can deliver earnings. And we saw that last year. If you segment the market in the two common ways it's done between growth and value, there is a huge divergence in performance. On one hand, you look at the performance of the Russell 1000 growth names. They were up almost 6%. And that was dominated by what was known as the FANG names, if you will, Facebook, Amazon, Netflix, and Google. Those names did terrifically well. They began the year very expensive for the most part. Here we've listed the PE ratio, the price earnings ratio, going into last year, trading Netflix at 71 times, Amazon over 300 times earnings, Facebook over 40 times, Google looking like the value at 17 times earnings. And the names got actually more expensive as the year progressed, as investors, again, were willing to pay almost anything for growth. The other half of the market, on the other hand, the Russell 1000 value, they were down almost 4%. So a huge divergence between value and growth of almost 10%. Very much a growth market dominated by a few names. And as a reminder, we're oriented towards relative value. Our returns are focused on relative value, and as such, our returns are close to the value index. not the growth index. Actually, somewhere in between over the long term is where we fall. And so last year was a tough year. We were very disappointed to underperform an S&P that was up 1.4. We were down about 1.4, and that's to be understood given this. We were in pretty good company. If you look at some of these growth names, for instance, Berkshire Hathaway, Warren Buffett's flagship portfolio was down over 12%. It just quite simply was a difficult year for value. And the point that we want to make is this is not the time to chase a very narrow market in which only a few names and a few themes have worked. To that point, not only has it been a growth market, but how narrow it's become is extraordinary. The S&P, as I said, was up only 1.4% last year, but if you look beneath the numbers, the 10 largest market cap names were up a whopping 22%. Again, those 4 names that we just took a look at contributed mightily to that, but the fact is that 10 names did very, very well. If you look at the rest of the index, though, the other 490 names in the S&P were actually down 2%. So it was a difficult year, very narrow, and this is an unusual period. The last time we saw a market this narrow was 1999, when the dot-com craze was in its full bloom. And we know that ended badly. And it's important to note that we don't think this ends badly for the market. It's different this time. Back in 1999, the technology sector represented almost 40% of the market. Now it's only 20%. And back in 99, the entire sector was very expensive, not just a few names. So the way we think this will play out is as investors get more confident with the health of the U.S. economy and more importantly the global economy, we'll see the market broaden out and these other 490 start participating more and money leaving, probably not always in an orderly fashion, those names that have been bid up very aggressively here in recent months. So again, we think people should stay the course, not try to change lanes at exactly the wrong time as this market broadens. But again, to move higher, it's all about economic growth. And in terms of the U.S. economy, we think we're in great shape. The consumer is 70% of the economy, and so as the consumer goes, so goes the economy, and they're doing very well. A couple of data points on that. Unemployment has fallen from 10% to 5% over this cycle. With that improving employment picture, wages have been rising now at a pace that we haven't seen in 9 years. Real wages grew at 2.5%. That's something that gave the Fed comfort in raising rates. Actually, people are finally getting more pay, and that translates into household net worth at an all-time high as we ended 2015. So the consumer is employed, they're making more money than they have in many years, their net worth is at an all-time high. Things are in good shape with the consumer. Now the risk to the economy is really not from internal but from external shocks, China being the poster child for that. Last quarter we talked about exports because slowing economies abroad, there was concern as to what that would do to the U.S. As a reminder, 13% of the U.S. economy is exports, and of that, China is 7%. So expressed another way, the U.S. economy is 99% something other than exports to China. So China in and of itself on an export basis isn't going to send us into recession. Now China does matter. It's the second largest economy in the world, and it's important to note the headline here in this chart, namely that China is rebalancing their economy. It is not crashing at this point in time. China has consciously, as the economy has matured and grown, made an effort to transition from an investment-based economy to one that's more consumption-based. That's natural. That's what other economies do as they evolve. To give you some numbers behind that, if you look at the Chinese economy in 1999, it was a $1 trillion economy. It was the 7th largest in the world, and 35% of the economy was what's known as capital investment. In other words, building infrastructure, roads, bridges, buildings, and so forth, as well as plant and equipment. If you roll forward now 15 years, the Chinese economy has grown tremendously, 18% in compounded over this time frame, and has grown to a $10 trillion economy, the 2nd largest in the world. And what's notable here is, though all segments have grown, look what's happened to the red slice here. The investment side has become almost half of the economy. And again, the Chinese government knows that's unsustainable, and their 5-year plan announced 2 years ago was to transition from this investment-based, manufacturing, export-oriented to a consumption-based focus. And out of that comes slowing growth as they rebalance. And again, law of large numbers, you can't grow at 9% every year at that size. So though it's painful and sometimes uneven as far as the trajectory, this rebalancing, it takes many, many years of fits and starts as the growth rate slows. What this means, bottom line for the rest of the world, are 2 things. One, that growth rates are going to be lower and that inflation is going to be lower. Not necessarily bad things. They really speak to a longer, more sustainable sort of economic cycle. Now, as far as risks to the capital market, interest rates rising is certainly one of those. Now that the Fed, in the first time in 9 years, has begun raising rates, the question is how high will they go and how fast? Our punchline here is that rates are going to go up, but not that much and not that quickly. Certainly not like the last cycle, which is portrayed here in blue. The last cycle between 2004 and 2006, the Fed raised rates 17 consecutive quarter point hikes over 2 years, taking the Fed funds rate to 5.25. We don't see anything like that this time around. In fact, if you think back to 2004 and 2006, the economy was booming, home prices were skyrocketing, commodity prices were melting up, stock market was doing well, and the Fed was fairly aggressively trying to slow asset bubbles down. They didn't succeed, obviously, in the housing market. But this time around, if you take a look at Fed governor forecasts as to where they think interest rates will be 12, 24, and 36 months out, you can see it's a much slower and lower sort of climb. And the pace matters here. The pace at which interest rates rise and the magnitude matters. We looked at capital market returns based on previous capital market rate hiking cycles and found this. And this is going back to World War II. In the case of fast rate hikes like we saw in the last cycle, the return for equities 12 months after the first hike was negative. It averaged a negative 3% return. On the other hand, for the slow rate hike cycles, one like we think we're going to have in this case, the return 12 months after the first rate hike was a positive 11%. So the pace matters, and the bottom line is we don't think interest rates are going to be an impediment to higher stock prices this year. Now, something that is getting a lot of play in the media right now is the election and what sort of risk that presents. And we look back to 1928 to see what election years meant to the stock market, and there's three possible outcomes, right? Number one is that leadership and party both change, and the average return in those election years was 6%. On the other hand, a better scenario is if the leadership changes but the party stays the same, the return has been 21% on average. And the third possible scenario, which isn't going to happen this year, of course, is that the president's reelected. At the end of the day, the average return for all election years for the S&P 500 has been a very average 11%. In other words, nothing out of the ordinary, very typical, and we don't think it's going to be any different this time. In other words, we don't think the election will be a capital market event. On the other hand, there are some implications for how we'll allocate money within sectors. For instance, regardless of which party wins, we think defensive stocks will do well. On the other hand, we think there's a lot of headline risk associated with pharmaceuticals as a couple of examples. But at the end of the day, for stocks to go higher, it's going to be all about earnings. And that was the case last year. To look back at earnings on the S&P 500, the earnings on those 500 stocks in 2014 was $117. This time last year, the expectation was for earnings of $128, so about a 9% earnings growth rate. But what actually happened, though the numbers aren't in for the fourth quarter, it looks like earnings are going to be essentially flat, right around $116. So earnings went nowhere, and so did the market. That's understandable because in a point in the cycle when interest rates are rising, it's really going to be all about earnings growth as opposed to multiple expansion. Now, why did earnings disappoint? Two reasons. Strong dollar hurt exports, and number two, plunging earnings in the energy patch took money out of the energy earnings for the S&P. In aggregate, that took $10 or $11 out of S&P earnings, and therefore we had a flat situation. Now, this is where the Groundhog Day scenario, where the capital market environment could look similar and the outcome could be different, comes to bear. We think that the bulk of the move for the dollar is over. We don't think it's going to get weak here, but we don't think it's going to climb like it did last year and the year before. Number two, we think the bulk of the damage has been done to oil prices, so we're not going to see that sort of damage done as far as headwinds to earnings in the oil patch. So with that damage done due to strong dollar and energy prices plummeting, we think that we can see revenue growth next year sort of in line with global GDP growth of around 4%. We think that margin expansion of 2% is very possible, as is another 1% through stock buybacks, taking earnings to about $125. So you get an 8%, 7% earnings growth, another 2% from dividend increases, and total return could be between 6 and 9% for the S&P 500 next year. Again, it's all going to be about growth, but that's the basis for why we still think U.S. large cap stocks we'll have a positive return as we go into 2016. To wrap up, in terms of asset allocation, as I indicated, we favor stocks over bonds. Specifically, we like developed markets over emerging markets. Emerging markets, though cheap, they're facing a lot of pressure with the rebalancing China, and though they're cheap, there really isn't a catalyst anytime soon here for us to start venturing into that space in a big way. Among the developed markets, the U.S. and Europe remain our favorites. And finally, we're underweight commodities with the exception of oil. As such, we're really entering 2016 much in the way we did in terms of asset allocation as the way we exited 2015. Thanks so much for your time and attention. Hope you have a great winter, and we look forward to catching up with you in the spring.